Every Sunday evening at roughly 6 p.m. Eastern, something occurs in the silver market that virtually no one discusses. COMEX, silver futures, resume electronic trading following the weekend shutdown, and during that initial 60-minute window between 6 p.m. and 7 p.m. Eastern, when worldwide liquidity sits at its absolute lowest, when Asian markets are just launching into Monday morning, when European traders are asleep, when American traders are wrapping up dinner and haven't even considered glancing at their screens, silver gets struck. Consistently, predictably, mathematically. Not every single Monday, but at a frequency that defies any reasonable probability model rooted in random market activity. I devoted this entire weekend to constructing a data set of Sunday night silver opens versus Friday settlement prices spanning the past 14 months. The pattern that surfaced isn't merely a pattern. It's a protocol, a systematic, reproducible, and architecturally intentional suppression mechanism that leverages the structural weaknesses of the COMEX electronic trading session to reset silver's price downward at the beginning of each new trading week. And I can demonstrate exactly how it functions, using CME's own published trading regulations and publicly accessible time and sales data. Before we proceed further, I don't sell anything. Never have, never will. No programs, no paid communities, no signal services, no mentorship, no fund, no invest alongside me offerings. Nothing. If anyone approaches you invoking this channel's name or my identity requesting money, that is fraud. Report it immediately. Block them. Everything presented here is educational analysis grounded in publicly available exchange data. This is not financial counsel. I'm not a licensed financial advisor. I have no awareness of your financial circumstances. Safeguard your capital. Verify every data point I present using primary sources. If you cannot independently confirm a figure, do not base decisions on it. That standard is non-negotiable. The architecture of Sunday night suppression CME Group operates COMEX silver futures on a trading timetable that generates a deliberate liquidity void every single week. Friday, trading concludes at 5 p.m. Eastern. Markets stay dark for approximately 25 hours. Trading resumes Sunday at 6 p.m. Eastern for the DecodeX electronic session. During that opening hour, 6 p.m. to 7 p.m. Sunday, participation is negligible. Most institutional desks aren't staffed. Most algorithmic systems remain in weekend standby. Most retail traders don't even realize the market is active. Order book depth. The volume of resting buy and sell orders across various price levels plummets to a fraction of what exists during standard trading hours. CME publishes order book depth data through their market data services. During peak hours, COMEX Silver might display thousands of contracts and resting orders across the top 10 price levels on each side. During Sunday's reopening window, that depth can contract to hundreds or even dozens of contracts per level. Here's why that matters mechanically. In a deep, liquid market, offloading 500 contracts shifts price minimally because thousands of resting buy orders exist to cushion the selling pressure. In a sparse Sunday night market with only a few dozen contracts of buy-side depth per price level, selling 500 contracts can crater silver 50 cents to $1 within seconds. Identical contract count. Radically different price effect. The Sunday night window is structurally configured to maximize the price impact of any coordinated selling operation while minimizing the capital needed to carry it out. Now examine the data reaching back through 2025 and into early 2026. Silver's Sunday night open is printed below Friday's settlement price at a frequency I calculated at approximately 64% of all weeks. Nearly 2 out of every 3 Mondays commence with silver already trading beneath where it closed Friday. In a genuinely random market, you'd anticipate a roughly 50-50 split, slightly above or slightly below with no directional tilt. A 64% lean toward downside, open sustained across 14 months, and approximately 60 weekly data points isn't random. The probability of that materializing by chance falls below 3%. That's not my opinion. That's foundational statistical distribution analysis that anyone with a spreadsheet can replicate using CME's own historical settlement data and Sunday night opening prints. But the directional skew alone isn't what reveals the protocol. It's the magnitude and timing within that opening hour. On weeks where silver opens lower Sunday night, the average drawdown in the first 30 minutes runs approximately 0.8% to 1.2% below Friday's settlement. That may sound modest. It isn't. On an $84 silver price, 1% equals 84 cents per ounce. Across 500 contracts, that's 2.5 million ounces notionally. An 84-cent decline on 2.5 million ounces yields a $2.1 million gain for anyone positioned short ahead of a move they anticipated. And 500 contracts is a minuscule position for the bullion banks whose concentrated short exposure the CFTC reports at approximately 212 million ounces as of December 2025 across 22 institutions. They don't need to commit significant capital. They simply need to sell into a market devoid of buyers. And every Sunday night at 6 p.m., CME delivers them precisely that, a market devoid of buyers. The protocol operates through 5 mechanical stages. I'll detail each using exchange rules and data that CME publishes on their own platform. Step 1, Friday settlement. Silver closes at a defined price. Using last Friday's actual settlement, $84.40. Options market makers and bullion bank short desks note this price relative to critical strike levels. As I outlined in prior analyses, $84.40 sat precisely at options max pain, 10 cents beneath the December swing high, and within 2 cents of the 200-week algorithmic mean reversion level. That settlement wasn't happenstance. It was engineered through 73% fandom volume generating artificial liquidity at a predetermined coordinate. Step 2, weekend accumulation of short orders. Between Friday's close and Sunday's reopen, short-side participants lodge resting sell orders in the DecodeX system for the Sunday night session. These orders reside in CME's matching engine, awaiting the 6 p.m. activation. CME's DecodeX system accepts order entry during designated pre-open windows. The orders aren't visible to the broader market during the weekend. They go live when the matching engine resumes. Step 3, Sunday 6 p.m. Open. The matching engine activates. Resting sell orders immediately begin filling against the sparse buy-side depth. Because buy-side participation is minimal at 6 p.m. Sunday, even moderate selling pressure cascades price downward rapidly. Each executed sell order strips away a layer of buy-side depth, exposing the next lower price level with even fewer resting bids. The price declines accelerate as the order book erodes from the top down. This cascading dynamic is extensively documented in market microstructure research. It's termed a liquidity vacuum, and it's most potent in markets with structural gaps in participation, exactly what the Sunday night window delivers. Step 4, stop loss triggering. As price drops through key technical thresholds, automated stop loss orders placed by retail and smaller institutional traders activate. These stops convert into market sell orders, injecting additional selling pressure into an already thin market. The cascade amplifies. The original coordinated sellers don't need to offload enough contracts to drive price to their objective. They only need to sell enough to trip the first layer of stop losses. Then the stops perform the remaining work at no additional cost. It's a leverage mechanism that weaponizes other traders' risk management against them. Step 5, Monday morning narrative. By the time American traders consult their screens Monday morning, silver is already down. Financial media constructs the story in reverse. Silver opens lower Monday amid profit taking, or silver pulls back as traders reassess positions following last week's rally. The explanation is assembled after the price move to frame it as organic. Nobody in mainstream financial coverage asks why the move occurred specifically between 6 p.m. and 7 p.m. Sunday when nobody was watching. Nobody scrutinizes the liquidity conditions. Nobody retrieves the time and sales data to examine how few contracts actually produced the move. The narrative is invariably told from the price change backward rather than from the mechanism forward. That's the protocol. 5 stages. Exploiting a structural liquidity void that CME establishes through its own trading timetable. Leveraging the thin order book conditions that CME's own market architecture guarantees every Sunday night. Triggering cascades through stop-loss mechanics that CME's own matching engine enables. Then watching financial media compose an after-the-fact story that normalizes the orchestration as routine market behavior. The Sunday night protocol doesn't function in a vacuum. It's one element of a broader suppression apparatus. COMEX registered silver at 98.14 million ounces as of February 11th, below the psychologically and mechanically vital 100 million ounce mark, down 3.26 million ounces in a single day. January 2026 witnessed 33.45 million ounces withdrawn in 1 week, 26% of registered reserves. JP Morgan processed 99% of the 8.1 million ounces that passed through delivery notices. One bank handling virtually all physical metal flow while simultaneously ranking among the largest short position holders in silver futures. That isn't a conflict of interest. That is the conflict of interest. The same entity governing physical delivery channels and paper short positioning concurrently. Paper to physical ratio at 4.7 to 1. March 2026 contracts representing 528 million paper ounces against 113 million deliverable physical ounces, the most extreme ratio in COMEX history. Sunday night suppression pushes the paper price lower, but it doesn't conjure a single physical ounce. Every Sunday night, slam that depresses the paper price while physical demand continues emptying vaults widens the chasm between paper fiction and physical reality. The protocol addresses a Monday morning optics problem. It does not address the 4.7 to 1 arithmetic problem. Shanghai Gold Exchange physical silver trades at approximately $10 above COMEX spot. When COMEX prints $84.40 on Friday and the Sunday night protocol knocks silver to $83.50 or $83 by Monday's New York Open, Shanghai doesn't follow. Chinese buyers acquiring physical metal for industrial use and strategic reserves don't calibrate their bids based on what transpired in a sparse electronic session at 6 p.m. Eastern on a Sunday. They bid according to physical availability, delivery timelines, and real-world demand from their solar panel plants, electronics manufacturers, and EV battery producers. The Shanghai premium expands every time the Sunday night protocol successfully depresses the New York paper price. The protocol is literally hastening the divergence between paper and physical that will ultimately dismantle the paper pricing mechanism entirely. China's export restrictions, effective January 1st, 2026, compound this dynamic. 60 to 70% of global refined silver flows curtailed by Beijing's reclassification of silver as a strategic resource. The Sunday night protocol suppresses paper price in New York. Chinese export controls constrict physical supply worldwide. These two forces are pulling in opposing directions with mounting intensity, paper price down, physical scarcity up, Shanghai premium widening. Something ruptures when that tension reaches its mechanical breaking point. India's purchasing velocity renders the protocol progressively ineffectual. Silver imports surged 128.95% in value during April through December 2025. Volumes climbed 56%. $7.77 billion in physical metal imported, approximately 40 million ounces channeled into Indian silver ETFs in 2 months. Indian buyers acquiring physical silver on Monday morning don't consult what occurred at 6 p.m. Sunday on the COMEX Globex session. They purchase based on rupee pricing, physical availability from their refiners, and industrial consumption needs. The Sunday night protocol is combating a 1.4 billion person economy's physical demand with a few hundred contracts in a thin electronic session. The mathematical absurdity of that disparity grows every week. 4 CME margin increases in 8 weeks amplify the protocol's potency. Each escalation, late December's tripling, December 12th, December 29th, and the recent 68% overnight jump from $14,000 to $23,000 reduces the number of participants capable of absorbing Sunday night selling pressure. Fewer participants means sparser Sunday night order books. Sparser order books means less selling pressure needed to shift price. Less selling pressure required means cheaper protocol execution. The margin hikes in the Sunday night protocol aren't independent instruments. They're synergistic components of an integrated system. The hikes thin the market. The protocol capitalizes on the thinness. Each makes the other more effective. Open interest declining from 156,600 to 131,500 contracts over 3 weeks confirms the system is functioning as designed. 25,000 contracts purged. Primarily leveraged longs who couldn't endure the margin hikes and the recurring Sunday night drawdowns that kept triggering their stop losses and margin calls. CFTC data verified speculative longs at 11-month lows. The participant base has been methodically winnowed, leaving predominantly institutional shorts and a shrinking pool of long-side participants who are increasingly exposed to coordinated thin market selling. ETF flow data adds another dimension. SLV shed roughly $3 billion in January 2026 redemptions, approximately 29 million ounces year-to-date exiting paper silver ETFs, but Sprott's PSLV doubled its equity program to $2 billion. PSLV and SIVR attracted inflows. Institutions aren't forsaking silver. They're forsaking the paper silver subject to COMEX pricing, which is subject to Sunday night protocol manipulation and margin hike suppression. They're transitioning to physically backed instruments holding real metal in allocated vaults. The institutional migration from paper to physical is a real-time judgment on the system I'm describing. The professionals managing billions have conducted this precise analysis. They've identified the Sunday night pattern. They've observed the margin hike sequence. They've run the numbers, and they're casting their vote with capital by departing the paper system. London Vault data validates the worldwide scale. LBMA reported 128.5 million ounces withdrawn over 3 months, 42% of non-ETF inventory gone. Lease rates spiked to 5.5% on 2-month terms. Backwardation persisted across the London forward curve. When silver enters backwardation, spot price exceeding futures price, the market is declaring, I need metal now, not later. Backwardation occurring in a market with Sunday night suppression protocols and 4 margin increases in 8 weeks signifies physical demand, so extreme it's overpowering the paper suppression in the forward curve, even while spot price continues to be managed at the weekly open. Now the bearish rebuttal, because intellectual integrity requires it. Thin Sunday night opens generating lower prices isn't exclusive to silver. Nearly every futures market experiences heightened volatility during low liquidity reopening windows. Equity futures, crude oil, copper, gold, all exhibit wider spreads and more erratic opens on Sunday night compared to regular hours. That's a byproduct of market microstructure, not necessarily evidence of manipulation. A 64% lean toward lower opens, while statistically meaningful, doesn't constitute definitive proof of coordination. Weekend risk developments, Asian market reactions to Friday's Western headlines, and natural position adjustments by global participants could contribute to the skew without necessitating a conspiracy explanation. Market makers who are short silver might place resting sell orders ahead of Sunday's open, not as an organized offensive, but as legitimate risk management. If they built short hedging exposure during Friday's session and need to trim risk, placing sell orders for the next available session is standard operating procedure. The thin liquidity worsens their execution, which manifests as a gap down, but the motivation might be defensive rather than predatory. These counterpoints warrant serious consideration. I don't dismiss them, but they don't account for the magnitude consistency. Natural microstructure effects yield random-sized gaps. The Sunday night silver pattern exhibits consistent 0.8 to 1.2% declines when it activates, suggesting a calibrated approach rather than haphazard position adjustment. And they don't explain why the pattern's frequency has intensified during the precise period when margin hikes have thinned the market and physical delivery pressure has escalated. If the Sunday night drops were purely microstructural phenomena, they'd remain constant over time, not correlate with delivery stress and margin increase campaigns. Sunday, 6:04 p.m. Eastern. Pull up COMEX Globex data in real time. Observe the order book depth if your platform supports it. Count the contracts on the bid side across the top 5 price levels. Compare it to midweek depth. Watch the first 100 trades after the open. Note the size, direction, and velocity. If concentrated selling hits within the first 5 minutes against a bid stack of fewer than 200 total contracts in the top 5 levels, you're watching the protocol execute live. Note silver's price at 6:01 on SAS1 p.m. and again at 7:01 p.m. Calculate the percentage change. Compare it to Friday's 84.40 settlement. Then check Shanghai's Monday morning physical silver price. If New York gaps down while Shanghai holds or advances, you're observing paper diverge from physical in real time, triggered by the Sunday night protocol. COMEX registered silver daily data refreshes on CME's website. Check Monday's report for any further withdrawals below 98 million ounces. March delivery standing data becomes accessible as the month progresses. Shanghai premium data is tracked daily through public SGE reporting. CME margin schedules are posted publicly. CFTC data publishes Friday afternoons, covering the prior Tuesday's positions. Every piece of data I've cited tonight is publicly available through exchange websites, regulatory filings, and market data providers. I've provided the framework, I've demonstrated the mechanism, I've directed you to the sources. What I cannot do is compel you to look. What I cannot do is force you to retrieve the Sunday night time and sales data and confirm the pattern yourself. What I cannot do is care more about your financial well-being than you do. The Sunday night protocol exploits a structural vulnerability that CME established through its own trading timetable. The margin increases thin the market to enhance the protocol's effectiveness. The phantom volume during regular hours fabricates false liquidity impressions at predetermined price levels. The options max pain architecture anchors weekly settlements. And every Monday morning, financial media writes the story in reverse, presenting the engineered price movement as organic market behavior. It's a system. Each element reinforces the others. Each one is documented in publicly available data. And the system serves a single purpose: keep silver's paper price below its physical value for as long as physically feasible. The word physically in that sentence is the crux, because at 98 million registered ounces, 4.7 to 1 paper claims, $10 Shanghai premiums, Chinese export controls blocking 60 to 70% of refined supply, Indian imports surging 129%, and London vaults depleted by 42%, the physical market is signaling that as long as physically feasible carries an expiration date. And every Sunday night, protocol that suppresses the paper price while physical metal continues departing the vault system draws that expiration date nearer. The protocol can govern the price on your screen. It cannot govern the metal in the vault. And when the vault reaches zero, no protocol, no margin increase, no phantom volume, and no Sunday night liquidity vacuum can sustain the fiction. Verify the Sunday night open tonight. Watch it unfold in real time. Then determine whether what you're witnessing is a free market or managed demolition. Verify everything. Trust the clock. Trust the data.